I'm Debbie Hancock and welcome to Get Financially Fit with Debbie Hancock. Today we're diving deep into the numbers that truly matter to your business. We're talking about the 10 key numbers that can make or break your business. Whether you're a seasoned entrepreneur or just starting out, these numbers will give you a clear picture of your business's health and help you to make data-driven decisions, not just emotionally driven decisions. So number one is revenue. This is the lifeblood of your business. What you want to do is track your income from all sources. And when I say track income, I mean VAT, any fees that are subtracted for, say, Go Cardless, Stripe, PayPal, etc. We want the true income number. If you sell a service for £100, then that income is £100. It's not £97.50 because the fees have been taken off. This is a really important number to track because you can do all sorts with this number. And it's understanding what money is coming into the business, and so rewarding you for all your efforts around product creation, service creation, marketing, etc. Number two is breaking that revenue down per service or product. So calculating how much income is coming in for each different type of product or service. I use accounting software for this. I use Xero, and I break my income down into lots of different individual places so I can see really where the big hitters are, so what's earning me the most money in terms of income, what income has increased, so I can do a comparison from, say, budget, what did I think would come in and what has come in, what came in over the last 6 months, and is there an uplift in certain products or services, or is there a drop in certain products or services. It really enables you to start questioning your business and questioning the numbers and the activity you're doing. So if you focus really heavily on one service recently, is that being reflected in the income coming up in that service? And actually, can you see the income dropping down in other services? So gross profit margin, this reveals the profitability of your business and services and products after deducting the cost of goods sold. So if you're a service-based business, this may not be as applicable, but if you're a product-based business, it will be your income, so your sales, less any direct costs associated with delivering that product. Then you will take your income less your direct costs, that will give you a gross profit, and you can do gross profit divided by income to give you your gross profit margin. And you can use this to understand how profitable that part of the business is. You can do comparisons, you can compare to industry norms, etc. Net profit margin, this shows the overall profitability after accounting for all expenses, and this is the number that most people really care about, especially in service-based businesses. So we take your income, sales, turnover, whatever you want to call it, you minus your direct costs and you minus your overhead costs. So they're all your other costs. They could be marketing, accounting costs, software costs, etc. Basically, what profit are you left with before tax? And then dividing that by your income to get your net profit percentage. And then you can use that again to compare to industry norms, compare to the prior year, the prior months, the prior quarter. Really question, is that the right level for you, etc. Cash flow, so monitoring the inflow and outflow of the cash in your business. What is left after you've paid for all your expenses? So the money coming in and then all your expenses going out, what money is left after that? Is that increasing? Is it decreasing? Does it need to be at a certain level because you've got high investments coming into the future? Are you looking to draw dividends and therefore you need that cash flow to be higher so you can do that? What's your hourly rate? It's really important to understand your hourly rate, not because I want you to charge by an hourly rate, but so you can compare to the minimum wage. Are you actually earning above minimum wage? So when you're looking at what to delegate out to, say, a VA or a social media specialist or an ad specialist, an accountant, whatever, you can compare the cost of you doing that task to the cost of them doing the task. And actually, if they might take 2 hours to do a task, that might take you 5 hours to do a task. And at your hourly rate, it doesn't make any sense for you to do anymore. So it's helping you to make logical financial decisions. And when you're pricing a product or a service, you can start to think, is this giving me what I want to earn from the business? Is it not? How does it make me feel? It enables you to start asking questions. Customer acquisition cost. So this metric measures the cost of acquiring a new customer, and it will be about reducing this cost or making sure that this cost is lower than your customer lifetime value, which is the next number we're going to talk about. So how much does each customer cost to acquire? This is where you can use your hourly rate. So if it's you doing all the outreach, social media posts, marketing, emails, etc., the activities to acquire a customer, you need to be using your hourly rate to work out your customer acquisition costs. If you're using external providers, what's that? And then monitoring that, is it increasing? And if it's increasing, are you still making profit from that customer? Customer lifetime value. You can calculate the total revenue a customer generates over their lifetime. And a higher one obviously means higher long-term revenue. So when you're looking at your customer acquisition cost, you obviously want this to be below your customer lifetime value. Else you're not going to be making any money. And you can also start to track which customers have a higher lifetime value. Do they have certain traits that mean that they have a lifetime value, or have you done certain activities with them? So have you reached out to them more? Have you followed up more? Are you providing a higher level service? What's the difference? I did this with a client, and we had 2 products, services that were £200 different a month. I couldn't see a massive difference between the service offering, certainly because he wasn't holding his boundaries with the lower priced service. And so when you looked at the customer lifetime value, we were actually seeing people were staying in the higher price service a lot longer than the lower price service. And the lower price services was causing him a lot of stress. So some people moved from that one to the higher one, and some people just left. It enables you to start asking questions about the business. Budget versus actuals. So compare your planned expenses and your planned income to your actual spending and your actual income. So for this year, 2024, we're nearly at the end. What was your forecast? What was your budgeted sales and costs for the year? And what are your actual costs and sales for the year? How did that compare? Why was there differences? What changed? Maybe the business changed. Maybe you decided not to pursue something. Maybe you went on a different direction and took up a different opportunity. Maybe you stopped reviewing your costs and so your costs increased. What was it that you did in the budget, or you assumed in the budget, that either did or didn't happen? And then start questioning why, what could I do about this, does it matter, etc. And then the expenses as a percentage of income. This shows how much of your income is spent on various expenses. It's a really interesting one with employees. So how much ROI are you getting on your employee cost? What's the percentage of employee cost to income? Because there's normally industry norms around this, and is it exceeding those norms? Is it below the norms? Is it that you haven't recruited yet and you're looking to recruit? It just enables you to start asking questions. If you see that, say, marketing is a really high percentage of your income, is that something that needs addressing? And with, say, accountant costs, they reckon between 2 to 5%. So 2% is a minimum, working up towards 5-10% of your costs if you've got a finance team in place and a finance director. So where do you sit in that? Does that feel comfortable? Do the percentages feel good to you? So by closely monitoring these numbers, you can gain valuable insights into your business's performance. Remember, numbers don't lie. They enable us to ask more questions. They challenge what we think is happening in the business, and they give us the true facts around what's happening. Then we can apply logic, we can ask those questions, and we can delve into our mindset. And perhaps it's our mindset that's prevented us from making the numbers we wanted to hit. Or maybe we actually exceeded them and we need to celebrate that and take the time to celebrate. So use the numbers to make informed decisions and drive your business forward. I'm going to put a quiz into the footnotes, and so you can find out what kinds of money person you are. So take the quiz and let me know how you get on.